Hey, good morning and welcome. We're here on the Iberian Peninsula. I'm in Portugal, and we're going to be talking to the two gentlemen from Fiduciary Wealth Management. That'll be Paul Correa on your screen now, and Matt Penfold. Good morning, gentlemen. How are you?
Good
Morning,
morning.
Carl.
Great to see you. How is life? How is the weather in the Iberian Peninsula?
Uh,
Another blooming rainy day here in Portugal.
yeah, it's a bit rainy and grey,
Well, that's
unfortunately.
okay. Well, let's see what we can do to cheer people up. How about you, Matt?
Yeah, the same. Yeah, it's okay. Yeah, it's I always say we moan about the weather. Give it 4 weeks, and the sun will be out, and we can go back to teasing those people in the UK about how glorious it is. Which is,
Oh,
I
wait.
think I've said before, is a bit of a sport for me. You know, you call up the family in the UK and say, "Oh, how's the weather there?" And you know
Yes.
what the answer is. And
You do,
yeah,
you do, and they get their
yeah.
bragging rights occasionally, don't they? Which is this time of year. But just so everybody knows, this isn't three British guys talking about the weather, which it could quite easily be thought to be this morning. It is the Money and Finance for Expats podcast from Fiduciary Wealth Management, and a special edition today. It is the launch of the Spanish and Portuguese Bonds, a special offer for you. But before we get into that, we're going to be looking at the global financial picture. That's how we customarily start off the podcast. So over to you, Paul, for that.
Thanks, Carl. I'll keep it very brief. So I've just identified three data sets that have come out both last week and two this week, and all US economic data. First one was the US unemployment data, which came out on Friday, which we mentioned in last week's podcast being a key data, and everyone would have their eyes firmly on the unemployment rate. Well, it was a huge economic surprise because the U.S. economy, contrary to every conceivable expectation from all analysts across, the big investment houses, the U.S. economy created 517,000 new jobs in the month, crashing estimates by considerably. The U.S. unemployment rate has now dropped to 3.4%, which is the lowest in 53 years.
Wow.
So this points to an incredibly tight labor market and much more resilient to higher interest rates than anyone envisaged. So the market interpreted this as a sign that interest rates will have to rise more than expected or stay higher for longer than they planned to cool the economy. Everyone was looking for any signs that the U.S. economy was starting to cool down. But no, there was no sign of that. So, as you would expect, equity markets starting to drop on Friday and open the week lower. It also crashed to some extent precious metals, gold and silver, and industrial metals as well. Um, So it seems that any eagerly awaited Fed pivot from a very tight monetary policy to a more looser monetary policy is going to be delayed or kicked further down the road, unfortunately. And then on Tuesday, yesterday, I haven't really had the time to look at what the data showed, but yesterday we had the U.S. balance of payments, and this report summarizes the economic transactions in goods and services, as well as capital flows and financial asset movements with the rest of the world. So the thing to remember is that the US has a budget deficit, which means the public expenses, the budget of running the US economy by the US state, they spend more than they recover, than they produce in tax receipts. Yeah,
Yeah.
that's why they're running a deficit. But there's also a balance of payments deficit, and the US is running what they say a double deficit. So the US balance of payments deficit came in November of last year with a shortfall of 61.5 billion. Normally, in a balance of payments deficit, you've got the current account, which is trade in goods and services, and the capital account. So very often the balance of payment, that's why hence the name always balances. And normally what you do is if you have a deficit in goods and services, in other words, you are importing more than you export in monetary value terms, then you balance it by attracting money into the economy on the capital side. Yeah. So it always balances. The figure for December, which came out yesterday, is supposed to show a slight improvement. As I said, I unfortunately for the listeners, it just hasn't been possible for me to extract that data. But they were looking at the trend in the last 6 months has been the deficit improving, still in deficit but improving.
Yeah.
And of course, eventually you want your balance of payments to be ideally in surplus. Yeah. So countries like Germany, which are exporters and manufacturers, they almost always run balance of payments surpluses. Um, so yeah, and normally what happens if you are importing more than you export, and you've got a deficit, then you try and very often raise rates to bring in money into the economy to compensate for the fact that you're buying goods in foreign currencies. So you want your currency to be relatively strong. So anyway, balance of payments is a side issue. The important one was yesterday. The U.S. Fed chairman Jerome Powell did a speech, and the market watches very closely his every word about future Fed monetary policy. So
Yeah.
all eyes are on what he has to say. The devil is always on the detail, because, of course, it came out with an unexpectedly strong jobs data, and everyone has been very edgy since, because uh, not only was it strong, it was exceedingly strong, with rates already at four and a bit. But he came out, and his rhetoric was what you would expect of a Fed chairman. He gives, a bit here and a bit there. On the one hand, he did say, as I would have expected, that interest rates might have to stay higher for longer and might even go higher than what the market is expecting now. So that's not good news. On the other hand, he said that there were signs of disinflation in the US economy. And whilst the labor market remains very tight, the goods sector is already showing, then the manufacturing of goods is already showing disinflation. In other words, the rise in the price of goods is dropping on a consistent basis,
Mhm.
and that accounts for 25% of inflation. So whereas the job market is very resilient, there's pockets of disinflation in the US economy,
Which is
which
different
leads
to deflation, right? Disinflation is inflation coming down to a point
inflation.
where we go into deflation, but for the time being, it's disinflation.
Disinflation, I mean, this is a loose. It's a very good point, Carl. It's a very loose use of the term. It's not that we're in a disinflationary environment, so no one gets confused. But you tend to use it in different scenarios. But it does mean that inflation is, as you rightly point out, coming down. So the trend is coming down, notwithstanding the fact that the labor market remains very tight. And of course, if you have a tight labor market, there's wage inflation.
Mhm.
Um, and he said that he can envisage inflation remaining stubbornly high throughout 2023 and possibly the early parts of 2024, but the trend is favorable. And sometime in 2024, the US inflation data should be closer to the target, which is 2%.
Okay.
So that's why I said he gave, he said, interest rates might have to be higher, they might have to stay higher for longer. But on the other hand, there's signs that inflation is coming down. So he's kept the language sufficiently vague to appease financial markets. And as you would expect, what happened late yesterday after the speech, all the analysts analyzed the language, the rhetoric, the implications, and they said, oh, but inflation, the signs that inflation is coming down, anything could change. That's a good sign. And the markets rallied strongly yesterday.
Very good.
Um, so it's very interesting because the whole financial system and global economy, to some extent, it sounds a bit, it doesn't make a lot of sense, but hinges on what is the Federal Reserve going to do
Mhm.
in terms of interest rates, and they, being the largest economy, lead the way. And it's so important that everyone keeps their eyes on the Federal Reserve and on any news from Jerome Powell regarding interest rates. So very interesting press conference yesterday. And there's loads of data, economic data coming out this week from different countries, but none of them are as relevant as yesterday's press conference.
Interesting times. Okay, and I think you've used the phrase before, hitting a wall. If we examine that analogy, has the wall been moved even further down the street?
Um, it's a difficult one because you would have expected, in all honesty, with interest rates having been increased so aggressively throughout 2022, and a further rate increase last week, you would have expected the US job market to have been showing signs of stress. Yeah. And yet we've had probably the largest increase in jobs in one single month for a long time. And in fact, the lowest unemployment rate in 53 years, despite a full year of aggressive rate increases. Very difficult to read. I would think that, with the goods sector already showing signs of disinflation, with the US housing market starting to weaken, that will feed into prices, and hopefully Powell is right in that the trend is more favorable.
Okay.
But the question is whether they will push. I don't know. I think we'll probably see rates staying, U.S. interest rates. I don't think they'll increase more than the market is expecting, although you can never say. But if inflation remains stubbornly high, then it would be reasonable to expect rates to stay at whenever it peaks in a month or two at those levels for the remainder of 2023. And how markets will react to that is anyone's guess.
And the Americans' debt, I mean, the American debt, just eye-wateringly,
Oh,
unimaginably huge. And the Germans, as you mentioned there, who'd like to have a surplus and a balance in that favor, must look at the American economy and think, well, that's not like how we would do it, right?
yes.
It
Well,
defies all sort of known logic, doesn't it, and precedent?
well, well. Remember, the balance of payments and the deficit are two different things.
Okay.
The balance of payments is in trading, import, exporting, and
Yeah.
flow of capital flows. But you're right that the U.S. economy carries an incredible debt burden of $31.5 trillion,
Yes.
and there's a cost to the U.S. exchequer to service that debt, and
Mm,
it is substantial. And if they keep rates high for longer, the budget deficit will continue to increase.
yes.
And if they continue to fund the Ukraine war as they intend to, that deficit will grow larger and larger and put a lot of strain on the Fed chair to consider the other side of the equation, which is, creating sustainable growth and be able to service the debt.
Hmm.
So this is why it's such a pivotal time in history, and why it is so delicately balanced. And I think Powell uses rhetoric like prior Fed chairman because he knows now what the game is all about. You have to, if your language is overly aggressive, the markets are going to crash.
Yes.
and with it, it could dent consumer confidence and bring the house of cards down. So
What
they
an
have to be
incredible
careful what they say.
responsibility. Yes, what an incredible responsibility. And some cynics might say part of the American game plan might be to invest in the Ukrainian war. And I use that word advisedly because ultimately that will be good for GDP and American companies.
Completely. I mean, I'm glad you raised that issue because there's already private equity firms, US ones in particular, making a public commitment that they will invest in Ukraine in their reconstruction and development. And absolutely correct. That gives a huge economic opportunity for US firms to come in and reconstruct Ukraine and get huge contracts.
Yes.
Of course, it's beneficial to the country because it's been flattened by Russian missiles, right? And the word flattened shouldn't be used um, uh,
What
when
light?
you I mean lightly, but the country has been flattened basically. So you're absolutely right. There's a huge opportunity for private equity firms, for American firms to win big contracts in reconstructing Ukraine. And I know it's the cynic in me, but they're looking at supporting the country, but they can also see the economic opportunity that can come out of that. They could join NATO and the EU alliance as well. There's already things happening in the background to see whether they could accelerate that. So yeah, you're absolutely right. It's after the destruction, and I always say this: after winter comes the spring. Yeah,
Mm.
bad days don't last forever.
But it brings a
Uh,
new sort of meaning to the question: who wins the war? Maybe the equity firms ultimately.
oh, can I
Um,
can I can I say something in
of
passing, which is
course, of
interesting?
course.
Yesterday was the most successful day the Ukrainian army have had in this war. They killed 1,000 Russians, and you know what's tragic in this? That the Russians were all rookies.
Yeah.
The how do you call it? The
Subscription. Yeah.
subscription, the
Conscripted.
300,000
Conscriptors. Yeah.
conscripted. They were put in the front line
Yeah.
with, I don't know what rifle it was. It was the most basic, with zero training, and there's a footage of Ukrainian uh, personnel that have been soldiers that have been conscripted into the Russian army, trying to run away in tanks, and the tank just turning over. I
Yeah.
mean, 1,000 Russians. I mean, they are as innocent as the Ukrainians. They don't want to fight the war. They've
Of
been
course.
forced into the front line with no training,
Yeah.
no proper ammunition, no safeguards for their safety. 1,000 Russian soldiers lost in one single day.
Dark times. Absolutely. It's
Oh,
horrific, isn't it?
horrific.
And also showing you that we're not afraid to go off piste and off a tangent whilst talking about the global picture here
Yeah,
on the Money and Finance for Expats podcast. Thank you for that update about what's going on around the world, and still, of course, everybody looking towards the American opinions and numbers and speeches. Of course, today a special day coming back to the Iberian Peninsula and fiduciary wealth management. We're talking about the launch of your Spanish and Portuguese bonds. Now, let me get this straight. We're talking about two separate bonds. It's not a Portuguese and Spanish. It's one of each, if you like.
absolutely. It's one of each,
Okay.
because every country has its own tax regime, and these bonds factor in the tax benefits that can be derived from structuring the bond in a particular way. So
Okay.
there's no one size fits all. It's on a country by country basis.
Okay. So share this good news with us, if you will.
Absolutely. Look, Matt and I are extremely excited to introduce the relaunch of our Spanish and Portuguese bonds. And Cal, as you know, and we keep repeating in our podcast show, we are passionate about positively shaping the wealth of the British expat community through tax-led wealth management advice. We want to help and improve the lives of the expat communities in the Iberian Peninsula that we are so proud and privileged to serve. And as you know, we're not a financial supermarket. and that's what makes us different. We're not churning out products off the shelf, so to speak. That's just not us. Um, we provide individually tailored, impartial, and holistic advice, and we treat each client as an individual, and we are perfectly attuned to their every needs and wants. That has always been our driving force. So we started this whole process about looking at the bonds introspectively. So first we looked at um, we started the process looking at what clients' needs were and working ourselves backwards to how can we change and how can we revamp and restructure these products to give more value. And we have, and Matt and I have put in every ounce of energy into creating a whole solution because we care and we care deeply about clients and we believe we can add considerable value to them. Um, I think the British expatriate community in the Iberian Peninsula deserve this, and we're going to provide all the help we can. It's a premium product. It's a massively improved version of the Spanish and Portuguese bonds, and we've integrated key additional benefits to create a superior product, which is recognizably better than anything else currently in the marketplace. Um, so we have quite aptly termed these bonds the Alpha Star Collection. You probably ask why we came with that crazy name, and it's very simple. Alpha in investment markets means providing excess returns over what the market produces. Yeah. So if the US equity market delivers for clients a return of 10%, alpha means that your investment portfolio can deliver in excess of 10.
Okay.
And we've called it alpha because we are providing more. We are providing the excess value. We call it star because we think that it's a star product, both of them.
Hmm.
And it's a collection of products which we hope to expand over time. Um, and we are bundling a package of added value for discounted price. So it's correct. Yeah, you haven't heard us incorrectly. We are giving more for less costs, and we're also, Carl, eliminating the complexity to make the product simpler and easier to use, whilst halving the establishment costs, making it. I mean, before it was already one of the cheapest products in the marketplace, but this is an insane offer, which is completely unmatched in the market right now. Again, I keep repeating the same thing, but we do it because we genuinely do care, and we want to do things better for people in our community because we are experts too, in a very concrete way, something that will be appreciated. We honestly believe that British experts will welcome this offer, which enables them to learn more about their overall financial situation and allow us to help them protect and defend the wealth that they've built over a lifetime from an overzealous taxman. Um, the British community, expatriate community in Spain, in Portugal, in Gibraltar, in the Iberian Peninsula as a whole, in our opinion, based on years of experience, have three basic needs. One of them, and we'll say the most important one, if you look at the hierarchy of needs, um, Maslow's hierarchy of needs is quite basic: to sustain their lifestyle in retirement. They want to live well, yeah. But there's a second important need, and that's to preserve and then transfer the wealth to their heirs in a tax efficient manner, in a seamless way,
Hmm.
because that's just nature's way. Yeah, you
Yeah,
want your
absolutely.
you want your children to do better than you've done, and you want to pass that legacy if there's anything left.
Hmm.
Of course, first and foremost, you have to enjoy your lifestyle in retirement. So the second one is the transfer of wealth to heirs, and then thirdly, which we come across time and time again, it's a taboo subject. No one wants to raise it in conversation, but it's one that has to be mentioned. Very often, British expats, when one of the spouses passes away or due to ill health, they do go back to UK.
Yeah.
Matt can tell you it happens continuously.
Yeah.
And the third basic need that we've identified is having sufficient resources, and we're talking about financial resources, to cover end of life care costs, which are not cheap in the UK, as you know. Um, so, what are we offering Brits? Let me explain what they're being offered now.
Can I
What?
take you back a little bit further for
Yeah,
the total financial muggles, and I include myself in
yeah.
that. What is a bond? Because sometimes we can take these things for granted, don't we? What are and I can hear that the alpha males of the wealth management world are announcing the alpha star bond. Can we start with what a bond is in essence by definition?
Matt, you want
Yeah, of
to?
course. We can go through that very quickly. Um, and we're talk about the Spanish and compliant bonds. So this is the basics. This is a product kind of as it's been in the marketplace up to now, and I think as Paul said, we've seen how these bonds have been offered and the value that's kind of lacking with those, and that's a key driver behind why we're trying to kind of launch this. So, Carl, if you can just kind of bring up, I think we've got a slide or a visual, and here's just a kind of very brief kind of explanation um, regarding the Spanish and Portuguese compliant bonds. And I think the key is that they have to be compliant in Spain or Portugal. So these are two separate products, as you said before. And I think I told a story last week actually about somebody who held an offshore bond. It wasn't compliant in Portugal, and they're going to have a very heavy tax bill because of this. But just to explain what it is, it's a lump sum investment, and it's written as a life insurance contract. So the bond is effectively a wrapper round the assets. So the equivalent is a UK bond or an ISA for those when we're in the UK. It's a wrapper, a tax wrapper around the assets that are there for invested. And the benefits of these bonds is there's no immediate capital gains, being very high in Portugal and Spain. And we always have to remember a lot of people watching may be within the NHR scheme in Portugal, or they may be planning. But one of the big things that NHR doesn't cover is capital gains. So planning is needed for that. And there is no tax on those gains. So there's no tax to pay unless a withdrawal or a surrender of the bond takes place. And when that does take place, you only pay tax on the gains. So that and we'll show a visual in a minute, but the bond provider can differentiate between what is return of capital and gains, and you only pay tax on the gains. And in Portugal in particular, that rate that you pay on the gains reduces the longer you hold the bond for. So this is not a short-term fix. This product is for somebody who wants to invest their hard-earned money that they built up through working in the UK. They maybe accumulated investments in the UK. Maybe they've sold property that they want to find a home for. And another feature with more specific to Spain, and Paul mentioned about planning. And so the bond can be set up so there's no succession tax in Spain. So it can be set up in joint names, and then it's passed to your loved one. And then on second death, the bond is held out to Spain. If the ultimate beneficiary is outside of Spain, there's no Spanish succession tax on that. So just to explain very briefly the taxation, Carl, if we move on to the next one. So this is based in Spain, and yeah, we may need good eyesight to read that one, but it's what we call tax deferral. So again, what I was explaining, there's no tax to pay until the withdrawal is made. So the visual there, thank you, Carl, demonstrate that. So you take a withdrawal, the calculation of what is return of capital and gain is calculated. It's split over, and then you pay the relevant tax rate on the gain element only. So it's a good way of kind of safeguarding that money. It gains in value. And as you can see there, there's a small amount of tax that's paid directly in Spain to Hacienda, the tax authorities. And this is where we arrive at the effective tax rate of 6.3%. This is in Spain. And then the next one in Portugal, exactly the same process, but there's an added benefit. So this is the longer you hold the bond for, the tax that you pay on the gain element reduces. So up to year 4, it's the standard 28%. Years 5 to 8, 22.4%. After that, 11.2%. So if you hold this bond for over 8 years, then maybe you're starting to take some withdrawals from it. Then you're paying 11.2% on the gain element only, which is where we come to that effective rate of 3.73. So that's the underlying structure of the bond, Carl. That's the boring part of it. And maybe there's a reason that I'm delivering the boring part and Paul's going to deliver the exciting offer. I don't know. But that's
thank you for illustrating that. That is really helpful for people.
no, that's the basics that how it works. But what we've seen in the past is somebody may say, yeah, here's a bond, invest your money, thank you very much, there you go. That's not what we want to do. We want to offer more for less, which I think Paul is raring to tell people about.
And also, before you do, Paul, I mean, the phrase we use here is wealth management. Just like invest and there you go and off you go is just the wealth. You guys are hands-on. Are you going to be helping people throughout the term of this as well, presumably, as in wealth management, with the key being the emphasis being on management, letting people know what they're dealing with here?
No, absolutely. I mean, it's exactly that. But I think where we're embedding value, it's at the front end of the process, where people are just sold the product, which I want to cover, because we need to understand, what are they getting now and what would they would get with the offer that we're making. But quick thing on something that Matt mentioned, 3 clear benefits of using bonds. One of them, the investments roll over free of capital gains tax in the country where they're based, so long as there's no withdrawal. So it's growing free of capital gains tax. Secondly, the low rate of tax that is paid on a withdrawal. And thirdly, succession tax, particularly in Spain, because there's multiple lives assured, it doesn't trigger a succession tax event on first death. The policy still has a head, which is the surviving policyholder. So it's a great product, but the product in itself doesn't solve all the problems. When you're giving holistic advice, as I mentioned earlier on today, you don't just sell a product. You look at the whole situation of the client and try to embed value in many different ways. But the most important thing before we get into the nitty-gritty of the product is what is standard now in the marketplace in terms of price and in terms of product. And in terms of product is just basically what Matt has just explained. And I go back to my analogy of the financial supermarket. You can go into the shop and get a product off the shelf, and it does all the tricks, that we've just explained. Whichever supermarket you go to, the product is absolutely the same. There's no tangible benefit to Tom, Dick, or Harry to go to another supermarket because they get the same thing.
Mm-hmm.
But we've reinvented the wheel here, and we're looking at ways of embedding significantly added value, which is what our advice is all about. Because why should they come to us if we offer no different to someone else? Then we're all about embedding value. But look at the price. If you search around, you'll find that most IFA practices in Spain and Portugal promise that you can get into a Spanish or Portuguese bond with no establishment fee. Now, you and I both know there's no such thing as a free lunch. It's just ridiculous. Anyone who's trying to market their services on that basis should not be trusted because it's untrue. We all know that. You can be sold that story, but let us tell you how these things really work. So when the IFA establishes the bond, in order to be able to claim that they can do it for free, they do it through a mechanism called an early encashment period of up to 7 years. So effectively, you tie down the client into the bond for 7 years. If you get out before the 7 years, there's hefty penalties to pay. That's how they do it. So
Mhm.
what are the implications? If they say we can do it for free, we can do it for free. We're just a charitable firm, and we're in business just because we love our clients, and we'll do it for free. And there's no charges to get in. And they normally tell you it's just the insurance company that's charging you. It's not us. It's the insurance company might charge you. We don't charge you anything. No, they use the early encashment mechanism because it disguises and covers those charges, which then become penalties if you encash it early. That's why it's called early encashment.
Yes.
And what the IFA will do is that they will take the maximum available commission, which could be as much as 7, and in some extreme cases, as much as 10%. Yep, Carl, we're not kidding you. 10%, 1 0,
Yes.
10%. And now, as you know, if the IFA is taking 10%, someone has to pay for it, right?
Mhm.
It doesn't, so the mathematics have to work, right?
Yeah.
The bond provider firm, which is mainly Atmost, they make the money. They are very explicit. The IFA business has to make money. And remember that unlike us, most of our competitors operate on a model where their advisors are on commission only. They
Mm.
are hungry individuals who have to feed their family. So let me explain how this works. The bond provider will pay 7 to 10% to the IFA because it's done under the early encashment charge facility. So they pay them immediately upfront, and then they start deducting the charges from the policy over the early encashment period of 7 years. So
Uh-huh.
they go, here's your 7%, 10% IFA. Now we have to recover that commission, right? Because Atmos are not doing it for the love of anyone. They also have to cover the commission they've paid the IFA. So over the next 7 years, they start withdrawing those commissions evenly spread over the early encashment period. But if you decide to surrender the policy early, then there's outstanding charges which have not been deducted, which become immediately payable before you cash in your policy. So what you're actually doing, Carl, is the client is indemnifying the IFA practice who walks away with a large commission payment in their pocket, but you are left with a bill to pay.
My goodness.
You
Okay.
are left, the client is left with a bill.
Yes.
It's clever, isn't it?
It
But
is, and a commission earning IFA might not be that upfront about that, all right, in their haste to sell you the product.
absolutely, that's why they proclaim and profess and swear that there's no charges. It's free.
Yes.
And we all know that is not true. But
Mm.
unfortunately, there's a lot of unsuspecting Brits in the Iberian Peninsula who really think that it's true that they don't pay, but they've made substantial. They've taken a large chunk of your hard-earned savings, and unless you've got a ethical firm and people with integrity putting this message out, there'll be firms that continue doing that. And
Okay. Couple of
for,
things
for
then.
and for us, it's a mission to go
Yes.
out there. We don't point the finger at anyone. We're just saying that this practice happens. We don't share that view. We detest it, and not every IFA firm is the same. We've never practiced it. We never will. If there's a price to pay for not doing it. We're prepared to pay that price. We
Yeah.
have been for 15 years, and that will never change. But we want unsuspecting Brits in 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 expat communities right across the Iberian Peninsula, whether it's Spain or Portugal, to understand
Yeah.
what they're getting into.
Well, you're making this transparent, aren't you? And I can understand when there's a meeting to talk about one's wealth management, and the light is sparkling on the water, and the lunch is very tasty, and the wine is flowing, and you're told that it's a free service. This product, you could quite easily put your hand across the table and shake hands on that, couldn't you, in your new home? And that lunch, as you say, thank you for decoding and making transparent that free lunch supposedly there. Even though the Prato do Dia in Portugal is very good value, it's still not free. You got to pay somewhere.
No, but you've set the scene and the context fantastic, and you're right. You wine and dine them. You open a nice bottle of wine. You've got the sun.
Twinkling.
uh, yeah, twinkling, and you see the life from a different perspective,
Yeah.
out in the sun, wine, sea, sangria, the good life. And you just need someone with fantastic oral skills to persuade you that this is the best thing since sliced bread.
Hmm.
But it's not, and they do a disservice to the industry, and they do not help the client. And uh, but but we have to say, in all honesty, that not all the firms are the same.
Yeah.
There'll be some that apply explicit establishment fees, which is more akin with what you would expect, and in the UK, which is full transparency. However, even when you're dealing with firms that have explicit fees, which is completely aligned to what we believe in, it is not uncommon for the establishment fee to be 3%, and maybe still, whether through an early encashment or otherwise, or if it's a large investment sum, maybe it could be reduced to 2, maybe,
Right. Okay.
maybe, but it's still better than this 10%, right? But it's still. Now, what is our price offer? Because I mean, we're establishing a bond for just 1%, for just one.
Okay.
I know that you're going to think that there's a game, there's none, 1%. And what is more, because we're embedding so much value, the 1%, we won't take it from the bond. So it's fully explicit. The entry, the entry fee for the bond will be 0. We will take 1% up front, embed all the value, because ultimately, if you want a product, it's just a product. We think that where we add value is all the additional benefits that we've integrated into this superior product.
Yeah.
So it means that, as I said, on the face of it, the bonds have some compelling tax benefit, but it's just a product which does not take into account the overall financial and tax position of the individual who needs tax efficiency.
Hmm.
So what we're doing is something which is easy and simple to use. So sorry, the bond in its current form is easy and simple to use, yes, but has no embedded value to the person if the advisor's sole interest is to sell you a bond.
Yeah.
And this is, Carl, what we are trying desperately to change. You're not you're not paying over the top for a product which is off the shelf without receiving the important bit, the juice, which is the individually tailored advice.
Yeah.
That's what we're changing. It's a game changer. It's a compelling offer because we are discounting the price to the bone, whilst at the same time offering all these additional and quite substantial added value benefits. So, and we're using specialized resources to integrate these key benefits and deliver a vastly superior product. It's putting a huge strain on our business because we're committing to offer all this value, and that involves behind the scenes having people having to produce some reports. But this is the essence of what we're going to give extra. So we're cutting the price even with our most competitive um, uh, our competitors which offer the best prices in the market,
Mhm.
we are at least halving the price as you get in.
Yeah, yeah,
So halving the price at least. If you compare it to someone charging you 7 to 10%, just the one, you can imagine how much more cheaper it is. But look at the free benefits we're giving. We'll produce a cash flow analysis report for the individual. Now we call it simulation reports because we take into account tax rates, inflation rates, rates of return in the market, how much the individual wants to draw from the bond. We've put all that into the mix and we use different simulations, yeah, with a tax rate of 20%, with a tax rate of 5, with inflation rate at 5, with inflation rate at 3, with returns of 8, with returns of 5 or 2. And we run cash flow simulations and see to ensure basically that you have sufficient, the individual has sufficient capital to either sustain their lifestyle in retirement or to preserve wealth for their heirs, or maybe just to sustain lifestyle and then hopefully have enough to meet end of life care costs, whatever their priority is. It could be a combination thereof. But we'll run the simulations to make sure that they're not living beyond their means
yeah.
and that we have sensible conversations about what is within their financial resources to spend.
Very
Because
good. Yeah,
because half of the Brits, Carl, honestly, I would say a third are very disciplined, very focused, understand finance, understand the need that they have to preserve capital as well as spend it,
yes,
because you cannot go over the top, you know. But you'll find that a lot of even well-educated Brits come to the Iberian Peninsula and then they lose their star, they lose their sense of direction, and they spend it so quickly that they honestly they go back to UK. We've had cases they
I'm
spend
sure.
their whole lot,
What an
and
interesting way of putting it. They lose their guiding star, their north star of fiduciary responsibility.
complete.
Yes, what an incredible phenomenon to observe. And yeah, you say it's like well educated. Well educated doesn't necessarily mean financially savvy, does it? At all?
Absolutely,
Yeah.
exactly. It
Rich
depends
dad,
on a,
poor dad. Yes,
yeah, exactly. Rich Dad Poor Dad, Robert Kiyosaki.
yes, yes,
Great
indeed.
book,
Yeah,
great
yeah,
book. And this is one benefit which I think people underestimate, but gives so much more value
yeah.
to clients. The second thing we do, we help the Brit plan an orderly UK exit, and we assess the impact of the UK statutory residency test in terms of when they should exit the UK to get their timing right. Because it's not just arriving in the new country; it's also timing it correctly from a tax perspective from the UK, but also in terms of your ties with the UK and how many days you can trip back to the UK without re-triggering UK tax residency through not thinking it through carefully. Yeah,
Wow. Okay.
I'm in Portugal, but I just fly back. There's
Yes.
a way of doing it. You have to consider your ties, but also your life, uh, your family connections, and your life pattern, maybe businesses. Before you leave, how many days do you intend to go back to make sure that you never, ever, ever trigger re-trigger UK residency? Then, Carl, that's the second benefit. The third benefit is that we review the individual's UK domicile status and assess any potential liability to UK inheritance tax, and then advise them on tax mitigation options, strategies, and techniques.
Mhm.
Because very often they think they confuse, they are two interchangeable words, UK domicile and tax residency, and they think that it is one and the same thing. It is not. They are two distinct things completely. And very often they remain UK domiciled and they have to consider the tax implications and how to restructure their affairs with UK domicile and a potential UK tax liability in mind. Because I don't think there's between direct heirs any Portuguese inheritance tax, but you're still UK domicile. Another important piece of value, extremely important, that we can save so much money. And then the fourth thing we do, we will deliver to the individual a comprehensive pre-arrival tax planning strategy report, which will cover all the relevant tax, financial, and retirement planning issues. Absolutely everything is covered there, including visas, and it goes into chapter and verse. And that is, and by the way, all those, this was the fourth added benefit. These are services that we marketed separately and we charge for separately. We are bringing everything into the equation. So we've halved the price and we're throwing all this in for free.
I like it.
And
This is fiduciary fitness, isn't it? You're taking people through a whole process here as part of
we are
this.
we are putting in through a process to make sure that when they arrive in the new country of residence, everything has been looked up. Every it has been done so thoroughly and conscientiously that they can rest assured that all angles have been covered, and then they
Yeah,
can just enjoy their lifestyle in retirement because it's been done thoroughly, properly, meticulously, with the best interest of the clients at heart, because that's what we want to do. We want to help because we care. We want to help the clients. And the
perfect.
fifth thing that we'll do, and that's the last thing I'll say, which will add considerable value too, we will also give specific advice on the timing of the sale of your UK main residence, if that's what the individual intends to do. Not everyone wants to sell their main residence, but some Brits will sell their main residence to either fund the acquisition of a property in Portugal or to use it as financial resources to fund their lifestyle. And there's a way of selling your UK main residence to secure UK capital gains tax exemptions. So we don't just think about tax when you arrive. We think about how can you time the sale of your UK property to avoid UK capital gains tax on that sale.
Yeah,
That requires, there's a science to that, and there's a way of doing it, and there's a window of opportunity after which some of those exemptions get diluted. We give value there too. The value could be not a lot or could be significant.
hmm. Can
That
I?
is for free. Five key major benefits, which take a lot of our time, a lot of our resources, a lot of our specialist skills, and we're giving it for free.
Let me see if I've understood then. I mean, what we're talking about here is a complete package of assessment, demystification, management, and confidence building. Because
Completely.
that's one of the things we've talked about before, isn't it? Especially you and I, Matt. Is when it comes to this area of life, hoping for the best is probably not going to be the best strategy. It's
Yeah,
okay with the
and
weather. It's okay
yeah.
going out for a picnic on the Iberian Peninsula. Hope for the best. But when it comes to this sort of thing, the governments and the taxing authorities will have different views to when it comes to crunch point, right? And they will be demanding their pound of flesh. So it's not good enough to just let it go and not be all over this.
No, peace of mind as well comes as part of one of those things
Yeah,
that it adds, Carl, and there is a huge importance of that. We say it quite often that a lot of people come here, maybe in retirement or whatever their circumstances, but you don't want to be worrying about these things. You want to be certain that everything's kind of structured in the right place, and we want to do that. It's not just a kind of pitch for us. We want to ensure that people we deal with, we can cover every base for them. That's
yeah.
part of the motivation to kind of put this package together. And yeah, as Paul says, it might put a bit of a strain on the team, but the team is prepared for that as well. And we will have to see how the offer goes. And it may be a case of we have to revise this. But as it stands, the offer is available, and it's an incredible offer, and it's unmatched. There's nothing out there even close to this.
Well, you used the word, thank you, Matt, and you used the word holistic before, Paul. I think it's certainly that, isn't it, in its reach, with the
Yeah,
five aspects and benefits that you talked about.
yeah.
It was interesting. As we were, of
Can I just mention something brief?
course, yeah,
No,
yeah.
no. Before I forget, the minimum amount is 250,000.
I was
We
going to
still
ask you. Yeah,
we still sterling. We still offer an extremely competitive price for mounts below 250, but the fee will be marginally higher.
yeah, okay,
So it
understood.
will still be incredibly competitive, and it doesn't jump from one to two or three. It is very, very measured any increase, but we have to charge because of the compliance that goes into onboarding a new client. But
Yes, of
we
course.
will
Yeah, okay. Well, we'll go into the specifics of who is this aimed at and who is this ideal for. But I love that hierarchy of needs. You mentioned Maslow before, and it might be useful on one of these podcasts to adapt the hierarchy of needs to this wealth management situation. You know, looking after oneself, looking after one's partner, the family, succession, untimely death of either partner, and of course legacy. People have other visions beyond their own personal and family wealth, don't they, to invest in trusts and philanthropy and so on. So that could be a whole way of looking at this wealth management we'll remix Maslow and create a wealth management hierarchy of needs maybe one of these days.
very
Um,
good.
with who this is aimed at, then presumably these are people who are tax residents in the respective countries of the Iberian Peninsula, either Portugal or Spain.
Correct. I mean,
Okay,
we live. Gibraltar hasn't got any bond as such
okay,
because of the low tax regime, but
all right,
it's meant for the British, and we haven't got any bias towards the Brits. The only reason why we focus on the British expatriate community is because we understand the nuances
yeah,
and the differences between both tax regimes. And I think that when it comes from someone comes from Sweden, then how can we look at it from a Swedish perspective? We would have to research, and we're
yes,
probably not the best to give that advice. Maybe there's a Swedish guy that can give that cross-border advice. Our piece is very simple, very easy, and very straightforward. We have a niche. It's a target market. It's the British expatriate community, and those are the ones we serve. But let me just, if you allow me to end,
sure.
I repeat it again. We do it because we care. We are passionate about serving the British expatriate community in this part of the world, of whom we are part of. And I keep repeating the same thing. It's a compelling offer because we're discounting the price and offering quite substantial added value. We're using our specialist resources within the company to integrate those key benefits and deliver what is, in our humble view, a vastly superior product. Um, and yeah, and it's a huge strain on us, but hey, you know what? There's more important things in life, and we will try and keep to this incredible promise
Okay.
of serving and helping the British expatriate community in Iberia.
All right. Well, it's 1% on the 250k.
No,
What's
1% on the investment amount, yeah,
yes,
whatever
of
the
course.
investment amount is.
And then what is the minimum input for somebody thinking, I want this?
I think that's a very good point. I think at most the bond provider has a limit, a minimum, which is I think 100,000 euros or £100,000. We
Correct.
we we have a minimum of £100,000.
Okay, so
So
100k is the minimum buy-in on
yeah,
this. And what sort of person is it aimed at? I mean, people are thinking, okay, I've got 100k or 250k, 500, a million to invest in something like this. Um, Setting this against property investment or other kinds of investment vehicles, what are the benefits of putting it in a bond beyond the benefits that you very clearly outlined there, but in a comparison terms with other kinds of investment?
well, it's good you raised that because when you look at things in context and holistically, it could be during that process of looking at domicile and inheritance that we determined that the bond is not just the only vehicle to use. There could be a better vehicle or could be combined with something else. We
Yes,
are completely agnostic in terms of the structure or structures. We just want to embed value for the client. We want to do the best for the client.
yes.
Um, and you're right. When you look at your total net worth, you should have property, and you should have other assets. Yeah.
But this strikes me as a foundational product because if you invest in property, that's not going to give you the benefits you've talked about necessarily, is it, in terms of
No,
taxation and looking after your family and your spouse?
no, but remember, there's a lot of added benefits in Portugal. For instance, you can downsize and you invest in a qualifying product, which could be the bond, by the way. Then you pay. Matt can tell you. I think you slash or no or don't pay half or pay much less capital gains tax.
Okay.
So you said it was a journey and a long-term relation. Is true. We will embed value throughout the client journey.
Yeah.
We're just giving a lot of, well, it's foundational because we're setting the foundations to make sure in the right place. But throughout their lives, we'll continue embedding value.
Do you know what? When we first started talking about this, I was thinking there's no way we can talk about bonds for an hour. We have just passed that hour point. It's been incredibly comprehensive and helpful to really understand what it is that you're sharing now from this day forward. And perhaps now's the time to conclude on this week's Money and Finance for Expats podcast. And we can, of course, take questions about it next week. And on the social media channels, if you want to put your question or comment in the chat sections of the various platforms that you'll find this podcast on, we'll make sure we address those in future episodes of the podcast. So it remains for a final word from both of you. Let's go to you first, Matt.
Yeah, I think you kind of had a question there, Carl. Who is this for, or who is it suitable? And if you're somebody kind of watching this and you think, is it suitable for me? There's only one way to find out. Reach out to us. You know, Paul said, okay, it's not necessarily this will be the perfect for you. It might be. The offer is incredible, but we look at the whole picture. That's what we do, and we find the most suitable thing for you. So if you think that or something else may work for you, you want to discuss your financial planning in Spain, Portugal, or Gibraltar with us, reach out. We're more than happy to have a chat. We're friendly guys.
There you go. All the details at fiduciarywealth.gi. Over to you, Paul.
Nothing to say. I think Matt has summed it up perfectly.
Nailed it there. Okay. We'll see you again next Wednesday morning where we talk to each other live in this format. And of course, you can catch up on all the usual channels, Facebook and YouTube. Great job today. And congratulations on this new product. Bye for now, gentlemen.
Thanks, Carl. Bye-bye.
Bye, Carl. Thank you.